for more on these jobs numbers, I want to bring in a couple of our panel guests. We have Dana Peterson of the Conference Board and Stephanie Roth of JP Morgan Chase Private Bank Senior Markets Economist. So, Stephanie, let's get right to you. What's your initial reaction to these numbers?
Initial reaction is better than what was feared yesterday, because the market doesn't really want jobs to be overly strong, because that really puts a pressure on the Fed to hike even more. But it still was a firm report. I think we have to remember that it still was a print above 200,000, which likely puts the Fed hiking in July, and it still keeps the door open to more hikes after that. A couple of other things that I noticed from the print: there was some downward revisions, 100,000 to the prior 2 months. So it definitely was a little bit softer than expected, except for the wage numbers. That beat by a little bit. So it's important to keep that in mind, that the Fed's likely to hike again, and it'll be data dependent from here.
Dana, how do you think the Fed is looking at this report, given the fact, like Stephanie just said, it's still above 200,000?
Absolutely. 200,000 jobs added is still very strong. The unemployment rate is very low. I haven't seen the detail, but I would imagine you're still seeing a lot of churn, especially in leisure and hospitality and healthcare, those sectors that are still facing labor shortages. And let's not forget the fact that wages are still very, very elevated, and they are being influenced by prices. And we received the PCE deflator data last week, and the core deflator is still very sticky. It's still being lifted by those core services as well as housing.
So, Stephanie, I want to just ask you what your reaction is, especially when you dig deeper into this, when you look at the number of people employed part-time for economic reasons. Does that give any cause for concern in terms of just kind of the path of jobs in the job market?
Yeah, so, I mean, we're starting to see some gradual softness, some softness under the surface, and I think that's important to sort of keep in mind, that the Fed is trying to slow down the economy. They're having some signs of that. It's just the economy's been proving to be a little bit more resilient than would otherwise be the case. But we are getting a gradual softening in the labor market. It's just taking a lot longer because businesses are still operating in a solid nominal growth environment.
Dana, when you take a look at that average hourly earnings month-over-month basis coming in slightly above expectations, 0.4% of a gain there, 4.4% on a year-over-year basis, you would think that that's still too hot for the Fed when the Fed is trying to get inflation under control. What does that number need to be in order for the Fed to be a little bit more comfortable with what the inflation outlook is going to be? Are we talking flat? Are we talking 0.1%? I mean, how high or how disappointing is a number like the print we got today?
Well, I think, anything that's flat or even negative, that would signal that there's cooling in wages. But again, we have these severe labor shortages, and many businesses, when we talk to them, the first thing they do to attract labor and also to keep labor is raise wages and increase benefits. And indeed, our own survey suggests that over the next 12 months, CEOs are still looking to raise wages by anywhere from 3 to 5%. So that's really steep, and we're probably going to continue to see that played out in the payrolls data.
So we saw some growth in certain sectors, obviously. We saw some growth in healthcare, adding, what's that number? Oh, my eyes. In the payrolls report. It's always such a tiny print, 41,000 jobs in June. So, some growth in healthcare. That was also different than what we saw in the ADP report yesterday. Government added jobs. Construction actually trended up. I guess that's a sign of kind of the just still being in the summer months and hiring there. Is there any sector that concerns you, Stephanie? I mean, we saw little change in professional and business service. And I know in general, the services sector, leisure, hospitality, little change. There was concern or has been concerned about from some economists and industry watchers about the services sector and how long it can hold up. What stands out to you is that may be potentially concerning?
Sure. So, well, first of all, the private sector jobs added just 149,000. So that's quite a bit of a slowdown from where we were, which was well above 200,000 the prior month. So you did get a bit of that cooling there. You did get a little bit of job losses in retail, in trade and transport. These are some sectors that actually overhired during the pandemic. Right. So it kind of makes sense that you're getting a little bit of softness there. There are a number of sectors that were benefiting specifically because of COVID, and you're getting some sort of pullback there. Technology is the most obvious, and finance, but there are some other sectors that are feeling that. And like Dana talked about, there are other sectors that are specifically within leisure and hospitality that are still seeing a strong demand for labor because they're still understaffed.
Dana, the average weekly hours that all employees have worked, and I know that was a key data point that you were looking at, that was actually ticked slightly higher, 34.4 hours, up from 34.3 the prior month. You were looking at that just in terms of if we did see a decrease, what that could signal for job cuts. What does this mean now, the fact that we did see a slight tick higher? Is that reassuring just in terms of maybe those job cuts would be pushed out a little bit, and reassuring to employees out there?
Well, a key thing is that when we ask CEOs what they're doing with their labor, 46% say they're not going to do anything. They're not hiring. They're not letting people go. They're hoarding labor, but they are reducing hours. So it didn't really show up that much in this report, but that's what we're hearing. And certainly that's a trade-off. Certainly, instead of letting people go, just letting them work fewer hours so you can hold on to them. And that's really because a lot of CEOs think, yes, there's still something on the horizon that may be negative, a recession or a soft spot, but it's going to be short, it's going to be shallow. And oh, by the way, we don't want to have to turn around and rehire labor if that's the case.
Stephanie, so when we hear that they are reducing hours, does that kind of match up with what your expectations were coming into this report, downtick in terms of the hours?
So coming into this report, I think I had to be a little bit concerned with the market yesterday, just because ADP did have such a big beat, and ADP's track record has been quite poor. But it just was another data point alongside a number of the ones that we've seen over the past couple of weeks that have been strong. So heading into this report, I wasn't necessarily expecting to see material signs of softness. Another thing that did pop out to me is that temp employment declined 13,000 on the month. That's another sector similar to the concept of hours that Dana talked about. That's another area that you tend to shed labor first. It tends to be a leading indicator of maybe some employment to come. So we do think that we'll see some softening over the course of this year. Our base case is the economy slips into recession towards the year end. But odds of a soft landing have gone up over the past couple of months.
What do you think, Dana? Do you agree with that, just in terms of the odds of a soft landing? Is that something that's still on the table? And what does that recessionary risk look like?
We still have a recession priced in, probably starting right about now in the third quarter, per our leading economic indicators. And also when we ask consumers and businesses what they think. We still think that the Fed has maybe one or two more rate hikes in its pocket. That won't cause a deep recession in our view. But still in all, we're looking at a soft spot here. I think that the risk that you do have a soft landing may have gone up a little bit, but the key thing is going to have to be inflation, and certainly in the labor market, seeing cooling there.
And Stephanie, remind me your expectation, one or two more rate hikes, and does this print today change that?
So we officially think one more hike, possible that there's another one after that. Our base case is that job gains have to slow to well below 200,000 in order for the Fed to be pausing. So this doesn't really accomplish that. We need further prints that are below the 200,000, but at least it's cooler than what was expected as of heading into the print.
Stephanie, what does this mean for investor positioning? How should they be prepared for the fact that we could see some more volatility here in the months ahead?
So we're certainly recommending that clients take advantage of structures. That's especially since a lot of our clients are concerned. That's a good way to take advantage. But a lot of our clients are overweight cash, and it doesn't make sense to be sitting here on the sidelines doing nothing. Cash over time is a big underperformer. So we think clients should get invested. There's a lot of opportunities, things like mid-cap equities that are a little bit more supportive from a valuation perspective. Things that are international, European equities have a bit more valuation support. And then, of course, adding from cash to core duration fixed income. So there's definitely a lot for clients to be doing. Sitting in cash is likely to be a losing strategy over the next 12 months.
And Dana, I want to ask you, are there any other data points outside of jobs that are concerning to you that kind of add credence to your view about us actually basically being on the precipice, if not in a recession already?
Sure. Well, I look at the JOLTS data, and we're not really seeing any improvement there in terms of vacancy shrinking. So I think that's a signal that the Fed still needs to keep going. And the more the Fed raises interest rates, the greater the likelihood we're going to go into recession. We're also very concerned about student loans. So certainly many people have experienced some relief over the pandemic. If they have to start, well, most likely they will have to start repaying back those loans. It's going to reduce the amount that they can spend. And that's actually bad thing for them, but a good thing for the economy if that could help bring down inflation. But certainly, again, looking at our indicators, our leading economic indicator has been negative for 15 out of 16 months, and it's very negative, and usually that signals recession.
Right.
So, Stephanie, then what is it? One of the sectors that you did not mention there in terms of the opportunity, consumer discretionary, and I bring that up on the heels of what Dana was just saying about the consumer, the fact that we are starting to see some cracks because the consumer had been holding up very, very well over the last several months. We're beginning to see a pullback. What does that mean for those consumer discretionary stocks and some of the shorting activity that we're seeing going on there?
Yeah, so the consumer is likely to be the next thing that softens in this economy. It's held up very well. You've seen slowdown in the manufacturing side of the economy. You've seen housing take a big hit. It's likely to be the consumer that's the next leg to soften, especially because it's driven by a strong labor market. And we're all talking here about the Fed is trying to cool down wage inflation, trying to cool down the labor market. So that's likely to be the area that would see the softness looking ahead.
And Dana, one last takeaway for you. What's your last, or the big picture from this print today?
Big picture is that I think this is still more fuel for the fire for the Fed to go. Most likely July, even though they keep talking about lags. It seems to me if you're concerned about lags, you might wait. But when you look at the inflation report, JOLTS data, payrolls data, and even the ISM data for services, it's all pointing to the Fed going in July.
All right. Dana Peterson, the Conference Board Chief Economist, and also Stephanie Roth, a JP Morgan Private Bank, a Senior Markets Economist. Thanks to you both for breaking down that jobs report.